Everyone who's made a video about this book tells you the same three things: buy index funds, avoid debt, retire early. And that's fine, that's true, but it's also the most boring possible way to talk about this book, because it completely misses why J.L. Collins wrote it in the first place. Here's the thing nobody says out loud: this isn't really a money book, it's a grief book wearing a money book's clothes. Collins didn't sit down one day and decide to write an investing guide. He wrote letters to his daughter because she told him flat out that she didn't want to think about money, didn't want to talk about it, found the whole subject stressful and boring. And Collins understood exactly why. He had watched his own stepfather get quietly destroyed by money stress, by not understanding it, by feeling powerless around it. That fear gets inherited. It passes from parent to kid, like a language nobody teaches on purpose. Think about financial fear, like secondhand smoke. It's this invisible, highly toxic stress that parents unknowingly breathe out into the living room, and their kids are just sitting on the carpet breathing it in. The children don't know what a mortgage is. They don't understand inflation, but they internalize the tight jaws, the unopened envelopes on the kitchen counter, the hushed, angry whispers after bedtime. Collins watched his stepfather suffocating on that exact smoke, that absolute paralysis of not knowing how to survive a system you rely on, and he didn't want that for his daughter Jessica. He was frantically trying to build an air purifier for her. He wanted to spare her from inhaling that same anxiety. That context fundamentally changes how you read this book. Because most financial literature is written from a place of aggressive optimization. The authors are trying to teach you how to squeeze the absolute maximum yield out of a portfolio, usually just to prove how smart they are. Collins is writing from a place of emotional preservation because his daughter didn't care about the math. When she said she didn't want to learn about stock betas, which is just a fancy term for volatility, or market caps, she wasn't being lazy. She was showing an avoidance response to a source of deep anxiety. Collins realized that if he built a complex, hyper-optimized financial machine for her, she would just tune it out completely. And if you tune it out, you're left vulnerable to the exact same forces that destroyed his stepfather. So the simplicity of his approach isn't just an investment strategy, it's a psychological shield. Here's the second thing almost nobody mentions. Collins wasn't always the calm, indexed, just buy the total market guy you meet in this book. He lost money, real money, picking individual stocks in the run-up to the dot-com crash. Fully confident, fully convinced he knew what he was doing, and he got wrecked like everyone else did. So when he tells you to keep it simple, that's not a marketing angle. That's a man writing from the other side of his own financial embarrassment. So here's my question for you before we even start. Are you investing because you understand what you're doing, or because you're scared of looking stupid if you admit you don't? Stick around, because the parts of this book people never talk about are the parts that actually matter. Let's clear the basics fast, because you've probably heard them already. Collins says put your money in a low-cost total stock market index fund. In the book, he uses VTSAX as his example. The pitch is simple. You can't beat the market consistently, so stop trying. Own the whole market instead, at the lowest possible cost, and let time do the heavy lifting. But before we even get to ticker symbols, we need to look at the mechanical foundation underneath that recommendation. He lays down a broader three-step formula first: avoid debt, spend less than you earn, invest a surplus. The way he talks about debt is incredibly visceral. He doesn't just treat debt as mathematically suboptimal. He doesn't bore you with interest rates and amortization schedules. He compares carrying consumer debt to being covered in blood-sucking leeches. To him, debt is an active drain on your life force. He literally instructs the reader to take a metaphorical sharp knife and start scraping the bloodsuckers off one by one, because otherwise they just keep feeding on you. The mechanism of debt, in his view, is that it steals your future time and hands it to a bank. And the leech imagery sticks with you because it takes the problem off a spreadsheet and puts it on your physical body. You feel it. Once you endure the pain of scraping those leeches off, you take whatever surplus you generate by spending less than you earn, and you build what he calls FU money. Arguably the best phrase in personal finance. I want to trace it back to its origin in the source material, because Collins didn't invent the phrase. He first encountered it in James Clavell's novel, Noble House, which came out in 1981. Collins writes that from the moment he read that phrase, his nebulous financial goals suddenly crystallized. It gave him a target. FU money isn't about accumulating hundreds of millions of dollars to buy a private island. It's a very specific utilitarian threshold of liquid capital. It's having exactly enough money in your accounts to comfortably walk away from any situation. A toxic job, a bad living arrangement, a compromising demand without risking your basic survival. It's basically the monetization of your own dignity. It gives you the right to say no. There's a story from his life that grounds this abstract concept in brutal reality. We have to talk about the September 11th layoff. We're looking at the aftermath of September 11th, 2001. The geopolitical landscape is in chaos. The markets are hemorrhaging. The economy is basically paralyzed. And in the middle of this panic, Collins gets called into an office at his company and he gets let go. The devastating irony here is that just 6 months earlier, his division president had taken him out for an extravagant lunch to celebrate an unprecedented, record-breaking year. They were drinking expensive wine, mapping out his seemingly invincible future with the corporation. 6 months later, his badge is deactivated. You can operate flawlessly. You can break the sales records. You can accept the accolades at the fancy lunch. And you can still be discarded because the company's stock dropped a few points or some macroeconomic shock happened. Your personal performance is completely irrelevant when the system demands a sacrifice. So he goes home. The news is running around the clock coverage of the crisis, and his 8-year-old daughter Jessica, the intended audience of this entire philosophy, looks up at him. She knows something is wrong. She knows he doesn't have a job anymore. And she asks with utter sincerity, "Daddy, are we poor?" Imagine the weight of that question from your child in the middle of a national crisis. But Collins doesn't panic because the leeches had already been scraped off. He's able to look her in the eye and say calmly, "No, honey, we're just fine. We have money that's working for us instead." That interaction is the beating heart of the whole book because in that fleeting moment, the abstract concept of Clavel's FU money became tangible reality. He hadn't built that surplus to buy luxury goods or a fancy car. He built it for exactly that Tuesday afternoon. He built it to purchase absolute psychological safety for his family. When the floor fell out from under the rest of the world, it acted as a shock absorber against a chaotic universe. But getting to that point requires a terrifyingly aggressive approach to saving. He introduces what he calls the shockingly simple math. It's simple, but it's not easy, because it really boils down to one primary lever, your savings rate. Collins advocates for a savings rate of around 50%, which shocks a lot of people. This is exactly where a lot of readers hit a wall. If you're making $60,000 a year and someone tells you to live on $30,000, with today's rent prices, grocery bills, and utilities, that borders on delusional. It feels like a starvation diet. It's an extreme proposition, but we have to break down the mathematical mechanism he's trying to expose here. He's demanding a fundamental shift in how you value capital. Most people view wealth as a measure of what they can acquire: cars, square footage, nice restaurants. Collins wants you to view wealth strictly as a function of time. If you're saving 10% of your income, it takes you 9 years of labor to purchase one single year of retirement. 9 years for 1 year of freedom. That's a long grind. The math dictates you'll be working for a very, very long time, but if you can manipulate your lifestyle to save 50% of your income, you trigger a dual action mechanism. First, you're stockpiling massive amounts of capital, obviously. Second, and vastly more important, you have permanently reduced the amount of money you actually require to sustain your existence. You've lowered your own baseline at a 50% savings rate. Every single year you work buys you 1 full year of freedom. You're attacking the timeline to financial independence from both ends simultaneously. You're literally compressing decades of labor into a fraction of the time. You're buying your life back at a discount. But this brings up a glaring contradiction. If the mechanics are genuinely this straightforward, avoid consumer debt, compress your lifestyle to save half your income, fund it all into a single broad-based index fund like VTSAX, and just ignore it for 20 years, why isn't this the default human behavior? Why do we have this seemingly biological urge to overcomplicate our portfolios? We want to buy crypto. We want to hold gold. We want to invest in private equity. We want to hire guys in three-piece suits to manage our accounts. The short answer is that simplicity is incredibly unprofitable for everyone except the investor. Collins isn't gentle about the financial industry. He calls it what it is. A machine built quietly and deliberately to keep you confused. Not because individual advisors are evil people. Most of them aren't, but the entire system runs on complexity, on obfuscation, on fees you don't fully understand, on products designed to sound sophisticated, so you'll defer to someone else instead of trusting yourself. Think about that for a second. An industry that profits more when you're confused than when you're confident, that should bother you more than it does. He's especially pointed about actively managed funds and the advisors who push them, not because those people are frauds, because the incentive is broken. Their job financially is to manage your money in a way that generates fees, not necessarily in a way that makes you rich. Those two goals overlap sometimes, not always. So when Collins says keep it simple, he's not just giving you an investment strategy. He's telling you to stop outsourcing your financial confidence to people whose paycheck depends on you staying dependent. That's not a footnote. That's the spine of the whole book, and he backs that up with devastating data. The critique of active management isn't a philosophical disagreement, it's a mathematical slaughter. Collins relies heavily on data from Vanguard and Standard & Poor's showing that over an extended timeline, roughly 82% to 90% of actively managed mutual funds fail to outperform their benchmark index. Almost 90% fail to beat a basic index fund. And that's not because Wall Street fund managers are incompetent. These are some of the most highly educated, ruthlessly competitive people on the planet. They're using supercomputers and algorithmic trading. So why do they lose? They fail because of structural anchors. First, there's cash drag. Active mutual fund has to keep a certain percentage of its assets in cash to handle investors withdrawing their money. That cash sits there, earning almost nothing, which drags down the overall return of the fund. An index fund doesn't face this issue to nearly the same degree. Second, there's trading friction. Active managers are constantly buying and selling, trying to time the market. Every trade incurs transaction costs and bid-ask spreads. Death by 1,000 paper cuts. And finally, the most destructive force of all, the management fee. If an active manager charges a 1% or 2% fee, they don't just have to beat the market, they have to beat it by their fee amount every single year just to break even for their clients. And the compounding effect of that fee over a 30-year investing lifetime doesn't just eat 2% of your wealth. Because that money isn't allowed to compound, a 2% fee can consume nearly 2/3 of your potential ending wealth. You are taking all the risk, providing all the capital, and the manager is siphoning off the majority of the compounding power. Picture it like taking your car to a deeply unethical mechanic. You go in for a basic oil change, which you could technically do yourself if you spent an hour learning how. But the mechanic doesn't just change the oil. While you're in the waiting room, they intentionally scramble your car's engine. They reroute the wiring. They install completely unnecessary titanium tubes. They cover the whole thing in warning labels, so when you finally pop the hood, you feel instantly terrified. You feel wholly unqualified to touch anything, and you slam the hood shut, hand them your credit card, and agree to pay an exorbitant retainer to maintain a monstrous contraption they built that they didn't even need to build in the first place. Collins is essentially walking up, popping the hood, pointing to a single easily accessible bolt and saying, "Listen, you just turn this. Don't let them convince you it's rocket science." But it's hard to trust him when the financial media is screaming the exact opposite around the clock. The media apparatus is deeply complicit in maintaining that complexity. Collins directs a significant amount of criticism toward financial television because it's fundamentally an entertainment product, and entertainment requires conflict and drama. Watching a calm academic explain that you should purchase a broad market index and literally do nothing for 40 years makes for abysmal television ratings. It doesn't sell advertising space, so they manufacture urgency. They parade a rotating cast of gurus across the screen. At 10 a.m., a perfectly coiffed analyst will look directly into the camera and insist the Dow is preparing for an unprecedented breakout. And then at 11 a.m., a different, equally confident analyst will argue that a sovereign debt crisis is going to trigger a global depression, and you must move all your assets into gold by Friday. Watching those segments, the psychological impact is profound. You feel a physical knot in your stomach, this intense, overwhelming pressure that you're supposed to be doing something, that if you're just sitting there holding a total market index fund, you're being naive. You're being negligent with your family's future, like you're asleep at the wheel. That anxiety is precisely the product they're selling. Action generates transaction fees. Activity feeds the machine. Collins uses a tremendous analogy to dismantle this urgency. He compares the stock market to a freshly poured mug of beer. When you pour a beer, especially if you pour it aggressively, you get the liquid at the bottom and a massive volatile head of foam at the top. The foam is chaotic. It surges up quickly. It collapses in on itself unpredictably, and fundamentally, it's mostly empty air. It's just noise. Collins argues that the financial media, the day traders, the guys sweating in three-piece suits on television, they dedicate their entire existence to analyzing the foam, trying to predict the micro-movements of individual bubbles. But for long-term investors, the foam is completely irrelevant. We're investing for the beer, and it's critical to define what constitutes the beer in this analogy. Why does the market fundamentally go up over long periods? It's not magic. The underlying liquid represents the aggregate progression of human civilization. When you buy a total stock market index fund, you're purchasing fractional ownership in thousands of companies. You're capturing population growth, technological innovation, the relentless human drive to increase efficiency and solve problems. As long as humans wake up every morning trying to improve their lives, and businesses try to turn a profit, the volume of the beer expands. The foam will fluctuate violently day to day, but the underlying liquid is what builds generational wealth. Now here's the chapter almost every summary skips completely because it's not actionable. It doesn't give you a clean bullet point, but it might be the most important part of the entire book. What happens emotionally when your portfolio drops 40% and you have to just sit there? Collins talks about sequence of returns risk, which sounds technical, but strip the jargon away and it's simple. It's not just about how much you invest. It's about what order the good years and bad years show up in, especially once you start withdrawing money. A crash early in retirement can do damage. A crash later wouldn't. Let's look at the mechanics of this because it's terrifying if you get it wrong. Two people retire on the exact same day, with the exact same amount of money. Over 30 years, they both experience an average market return of 7%, but retiree A gets hit with a massive market crash in years 1, 2, and 3 of their retirement. Retiree B gets that exact same crash, but it doesn't happen until years 27, 28, and 29. The outcome is drastically different because of the withdrawal mechanism. Retiree A is forced to sell shares to pay for groceries and electricity, while those shares are down 40%. They're locking in those losses just to survive. They're cannibalizing their portfolio at the worst possible time, meaning those shares are permanently gone and cannot participate in the eventual market recovery. Retiree A might go completely bankrupt. Retiree B, who experienced a massive bull market early on, has built up such a massive cushion of compound growth that the late-stage crash barely dents their lifestyle. They die incredibly wealthy. The sequence of the returns dictates your survival. So to prepare his readers for this inevitable volatility, Collins forces them to confront what he calls the big ugly event. You have to look the monster in the face, because you cannot adopt a passive index strategy. If you're going to panic and hit the sell button the first time the S&P 500 drops 15%, you have to accept that market crashes are not an anomaly. They're a feature, not a bug. He walks the reader through a morbid history of economic terror to prove this exact point. He starts with the Great Depression in 1929, where the market lost nearly 90% of its value over 3 years. Unimaginable. But he doesn't stop there. He dives deeply into the brutal bear market of 1973 to 1974, triggered by the OPEC oil embargo and the collapse of the Bretton Woods system. The market dropped nearly 50%, and he details the suffocating stagflation of the late 70s and early 80s. Inflation was running double digits. Mortgage rates were pushing 18%. People felt economically trapped. He highlights the infamous 1979 cover of Businessweek magazine, which boldly declared the death of equities. The consensus was literally that the stock market was a relic of the past, that nobody would ever make money in stocks again. And the irony, of course, is that declaring the death of the market immediately preceded one of the most explosive, prolonged bull runs in modern financial history. The media got it completely backward. Then you get to Black Monday in 1987, the dot-com bubble bursting in 2000, the geopolitical terror of September 11th, and the complete systemic meltdown of the housing market in 2008. The takeaway is profound. If you're waiting for a moment in time where the horizon is perfectly clear, where there are no political crises, no inflation threats, and no global conflicts, you'll wait until you're dead. The market climbs a wall of worry. It always has. To illustrate the fortitude required to survive these events, Collins points to Warren Buffett's behavior during the 2008 financial crisis. This is a staggering example. Between the fall of 2008 and the spring of 2009, as the global banking system teetered on the brink of total collapse, Buffett's personal net worth plummeted from roughly $62 billion down to $37 billion. We have to pause and absorb that number. He lost $25 billion in months. We classify that as a paper loss, but if you log into your investment app on a Tuesday and see your life savings cut in half, your chest gets physically tight, your breathing gets shallow. It's hard to fathom the psychological fortitude required to watch $25 billion vaporize and not intervene. And that's why the word lost is always in quotation marks in this context. Buffett didn't actually lose anything because he didn't hit sell. The mechanism of loss is the act of selling. He refused to sell. He understood that market timing, trying to guess the bottom to jump back in, is a statistical impossibility. He recognized the contraction as a natural, albeit severe phase of the economic cycle. He sat on his hands. The market inevitably recovered, and his wealth exploded beyond its previous peaks. Collins takes this a step further, and he presents a deeply contrarian view on market crashes. He argues that if a severe crash occurs early in your career, during your wealth accumulation phase, it's actually a massive stroke of luck. He calls it a gift. That's hard to accept. When 2008 happened, nobody felt like it was a gift. People were losing their homes, losing their jobs. It was incredibly traumatic, and it takes a severe rewiring of your instincts to see it as a gift. But here's his logic. When you're 25 or 30 years old and you're automatically funneling part of your paycheck into the market every 2 weeks, you're fundamentally a buyer of stocks. If you go to the supermarket to buy coffee and you see that the price of your favorite coffee has dropped by 40%, you don't burst into tears. You load up the cart, you celebrate, you buy extra bags. Yet when the stock market drops 40%, people who are actively in the buying phase of their life panic because the news tells them to. Collins argues that an early career crash means every dollar you invest is suddenly buying significantly more shares of the greatest companies on earth. They're on sale. Furthermore, the dividends those companies pay are being automatically reinvested at rock bottom prices. You're aggressively accumulating the engine of future wealth at a steep discount. It's easy to understand the math, but it's worth pushing back on this a little. It's infuriatingly easy to sit here casually reviewing historical charts and say, just buy the dip, stay calm like Buffett. It's so easy in hindsight, but how is the listener actually supposed to do that when they're living through the collapse of Lehman Brothers? You don't have a crystal ball telling you the market bottoms out in March of 2009. For all you know, the ATMs are going to stop dispensing cash tomorrow. Your neighbors are being foreclosed on. It felt like the end of capitalism. Every survival instinct hardwired into our primate brains, the amygdala screaming at us to flee from danger, is telling us to liquidate everything and hide cash under the mattress. How do you override millions of years of evolution just because a book told you to? That pushback, that exact feeling, is exactly why this book achieved cult status. Because Collins doesn't answer that question from the ivory tower of academia. He doesn't dismiss the fear. He answers it as a man who experienced that exact primate panic, succumbed to it, and paid an agonizing price. Which brings us to the guru's own scars, because despite the calm, grandfatherly tone of the book, Collins wasn't born with an iron stomach. He had to learn it the hard way. We already talked about Black Monday in 1987. Collins was an active investor during that crash, and his retelling of that day is painfully raw. It's a masterclass in vulnerability. He sets the scene perfectly. It's October 1987. There are no smartphones, no instant stock apps, no live tickers in your pocket. The only way to know the damage is to call a human being. At the end of the trading day, Collins picks up the phone and calls his broker, a man named Bob. He tries to sound casual, asking, "Hi Bob, how's it going?" And he describes the chilling, heavy silence on the other end of the line. The silence of a guy who just watched the world burn. Bob finally speaks and tells him they've just survived the largest single-day market meltdown in history. The Dow Jones Industrial Average plummeted over 22% in a matter of hours. The panic on the trading floors was absolute. If you had $100,000 at breakfast, you had less than $78,000 by dinner time. The sheer violence of that drop is staggering. At first, Collins attempts to channel his inner Buffett. He tries to be stoic. He holds on to his positions for several months as the market continues a slow, agonizing, drifting bleed downward. Intellectually, he knew the historical data. He knew markets recover. But the intellectual knowledge hadn't penetrated his nervous system. It never does when it's your actual money. The daily psychological torture of watching his net worth erode finally broke him. His nerves shattered. He called Bob and ordered him to liquidate his entire portfolio. And here's the tragic punchline, the absolute worst case scenario for a market timer. He capitulated and sold almost exactly at the absolute bottom of the market. He locked in the maximum possible loss, almost to the day. And then as the mechanics of the market dictate, the recovery began. The market started its slow, relentless climb upward while he was sitting in cash. He was paralyzed by the trauma of the drop. It took him nearly a year to muster the psychological courage to reinvest his money, by which time he'd missed the rally. By the time he re-entered the market, prices had surged well past their pre-crash highs. He had locked in massive permanent losses, and then paid a massive premium just to buy back the exact same assets he previously owned. He bought high, sold low, and bought higher. He describes it in the book as an utterly humiliating failure of nerve. And he didn't stop there. He shares another disaster, the story of Mariah International, a gold mining penny stock. The guy who preaches total market index funds bought a gold mining penny stock. This was his foray into trying to swing for the fences. The slow, steady accumulation of index funds felt boring. He wanted the dopamine hit of uncovering a hidden gem. He wanted a high upside individual stock that would make him wealthy overnight. He invested $50,000 into it. The company eventually went bankrupt and the stock went to zero. He incinerated $50,000 simply to learn that he possessed zero talent for picking winning stocks. This changes everything about how the reader receives his advice. If you read the Bogleheads forums or scan the endless pages of Goodreads reviews, they aren't just praising the 50% savings rate, they're responding to his honesty. They're praising his complete lack of ego. When he tells you not to day trade, he isn't lecturing you from a pedestal. He's not wagging his finger at you. He's sitting across the table showing you his financial scar, saying, "Look, I thought I was a genius too. I let my ego drive the bus. I lost $50,000 and I panic sold at the bottom of the worst crash of the decade. Do not be an idiot like I was." It completely disarms the reader's defensiveness because he validates the fear. He admits that the primal urge to flee is overwhelming, and he advocates for the simple path because he proved to himself through agonizing trial and error that he's incapable of successfully navigating a complex active strategy, and statistically speaking, his readers are incapable too. It's powerful, but reading through the Reddit threads and the intense forum debates, there's room for a little skepticism. It's very easy to read this narrative and treat it as infallible scripture, which is a trap people fall into. This simple path was built by an American For Americans, inside a tax-advantaged dollar-denominated system with decades of stable income assumed underneath it, that's a lot of built-in privilege. If you're outside the US, the specific fund recommendations don't translate directly. If your income is unstable, if you're supporting dependents in crisis, if you don't have decades of runway left, just keep buying index funds and wait is a much harder sentence to live inside. It could feel completely disconnected from reality for some people. That's not a takedown of the book. Collins himself would probably agree with most of this. But summaries that treat this book like scripture instead of a starting point are doing you a disservice. That nuance is critical. And if you look into the Bogleheads community, arguably the most sophisticated hub of passive index investors on the internet, you'll find fierce, highly technical debates tearing apart some of Collins' more dogmatic assertions. The loudest argument is definitely about international stocks. In the original printing of the book, Collins took a remarkably rigid stance against buying international stock index funds. He was all in on America. His rationale was based on the fact that the major companies within the US total stock market, companies like Apple, Microsoft, Coca-Cola, are massive multinational conglomerates. They sell everywhere. They already generate a huge percentage of their revenue overseas. Therefore, he argued, you are already getting international exposure simply by holding US stocks, but you avoid the currency fluctuation risks and the murky accounting standards of emerging markets. He was a devout VTSAX purist, 100% US equities. The Bogleheads vehemently reject that, because their entire philosophy is predicated on maximum diversification. According to modern portfolio theory, the standard Boglehead approach advocates for a 2 or 3 fund portfolio, where a substantial portion of the equity allocation, usually between 20 and 40%, is dedicated to an international index fund or combined into a total world fund. They argue that Collins suffers from severe recency bias. Just because the US market has dominated global returns for the past decade and a half does not guarantee it will continue to do so for the next 40 years. By excluding international markets, you're making an active bet against the rest of the globe, which isn't very passive when you think about it. But what's genuinely impressive about Collins, however, is his willingness to absorb this critique. He updated it. In the 2025 revised edition of his book, he significantly softened his ex-US stance. While he maintained a personal preference for the US market, he formally acknowledged that adding a broad international index is a mathematically sound choice. It provides a smoother ride for investors worried about a US-specific economic decline. That flexibility is rare in the personal finance space. Most gurus double down when they're challenged. They protect their brand at all costs. Critiques don't stop at asset allocation. The Goodreads reviews go after his tax strategies, specifically his views on the Roth IRA. The tax optimization debate is fascinating because in the original book, Collins leans heavily toward traditional tax-deferred retirement accounts, the 401k style. His logic is that you should take the tax deduction today while you're presumably in a higher tax bracket during your working years and pay the taxes upon withdrawal in retirement when your income is lower. Makes sense on the surface. He was fairly dismissive of the Roth IRA, where you pay taxes on the money up front, but it grows and is withdrawn completely tax-free. But reviewers point out a major flaw in how he calculates the tax burden for young people. They expose a flaw in his assumptions regarding marginal versus effective tax rate. Collins uses a simplified example where contributing $5,000 to a Roth essentially costs you $6,250 of gross income, because he assumes a flat 25% tax bracket. But critics highlight that this ignores the reality of early career earners. If you're 24 years old working an entry-level job, your effective tax rate might be incredibly low, maybe 10 or 12%, so it's cheap to pay the tax now. It's almost undeniably mathematically superior to pay that tiny tax toll up front, lock the money inside a Roth wrapper, and enjoy 40 years of tax-free compound growth. Furthermore, the FIRE community, the financial independence retire early crowd, relies heavily on complex tax maneuvers that Collins glosses over, like the Roth conversion ladder. This is a mechanism that allows early retirees to shift money from traditional accounts to Roth accounts in low-income years. It effectively accesses their retirement funds before age 59 and a half without paying early withdrawal penalties. It's advanced tax mechanics, and it's missing from the simple path. There's also a major debate around target date funds. Collins generally praises them because they're the ultimate set it and forget it mechanism. They automatically shift your money from aggressive stocks into conservative bonds as you age. He praises their behavioral benefits. If you know you're prone to tinkering, a target date fund prevents you from touching the dials. However, the FIRE community heavily criticizes the glide path of these funds. A glide path is the predetermined schedule the fund uses to become more conservative. If you plan to retire early at age 45, the target date fund assumes you need maximum safety right now because you're retiring, so it'll dump a massive portion of your wealth into low-yielding bonds to protect your capital. But if you're retiring at 45, you might live to be 95. You have 50 years of inflation to combat. You're facing massive longevity risk. If your portfolio is locked in bonds, it might not grow fast enough to sustain your withdrawals, and you could run out of money in your 70s. Which leads to the famous Reddit hack for target date funds. How do they bypass the conservative glide path? They introduce a structural deception. They intentionally select a target date fund that's dated 15 or 20 years past their actual planned retirement date. If they plan to retire in 2040, they buy the 2060 fund. This allows them to retain the behavioral simplicity of a single fund, but it forces the fund's internal algorithm to maintain a highly aggressive, stock-heavy asset allocation, so it stays aggressive throughout their early retirement decade, ensuring the portfolio continues to outpace inflation. So considering all of this, adding international exposure, optimizing Roth conversion ladders, hacking target date funds, does the simple path break down? If a listener implements these complex adaptations, how do they avoid sliding backward into the fee-driven, scrambled engine trap discussed earlier? It's a vital distinction to make. Adapting the strategy does not break the philosophy, because the underlying physics remains intact. The simple path was never solely about the specific ticker, VTSAX. The true simple path is defined by broad diversification, absolute avoidance of active management, merciless compression of fees, and maintaining an aggressively high savings rate. So the vehicle can change, but the engine is the same. Whether you implement that philosophy using one US fund, a global fund, or a hacked target date fund, you're still operating safely within the boundaries of the methodology. You're still refusing to pay the mechanic. You're simply choosing to use a slightly different grade of synthetic oil, and that perfectly bridges the tactical mechanics back to the emotional core. Because ultimately, optimizing the tax drag on a Roth isn't the true endgame, and that perfectly bridges the tactical mechanics back to the emotional core. Because ultimately, optimizing the tax drag on a Roth isn't the true endgame, it's just a tool. Before we get to the final takeaway, it's worth briefly defining a concept Collins leans on heavily for retirement, called the 4% rule. For anyone unfamiliar, this essentially states that if you have a diversified portfolio, you can withdraw roughly 4% of its total value in your first year of retirement. You adjust that dollar amount for inflation every year after, and statistically, you'll almost certainly not run out of money over a 30-year period. It's the mathematical finish line of the accumulation phase. So here's what this book is actually about. Underneath the fund names and the 4% rule, it's not about becoming rich. It's about becoming ungovernable by fear. Fear of your boss, fear of the market, fear of not understanding something you were never taught. Collins didn't write this for people chasing yachts. He wrote it to stop a cycle. He wrote it for a daughter who was scared of a topic nobody explained to her honestly. To understand the success of the book, we only have to look at the outcome for the person it was explicitly written for. Jessica, Collins' daughter, eventually internalized the letters. She adopted the strategy, but she didn't become a financial analyst. She didn't subscribe to financial television or spend her weekends dissecting corporate earnings reports. She set her savings rate. She automated her investments into the index, and then she walked completely away from the subject. She let the machine run. She went off to live a vibrant, fulfilling life, completely insulated from the financial anxiety that plagued her grandfather. The profound thesis of the book is that humanity has vastly more important work to do than monitor fluctuating digits on a screen. Collins explicitly states that we have bridges to engineer, diseases to eradicate, treaties to negotiate, and children to raise. The ultimate goal is to reclaim your mental bandwidth. If you amass a $10 million portfolio, but you spend 3 hours every day stressing over Federal Reserve interest rate hikes and checking your stock app during dinner, your money still owns you. You're just a highly paid employee of your own portfolio. The simple path is engineered to sever that psychological tether. It relegates your wealth building to a silent machine in the basement of your life. It hums along, compounding in the dark, doing its job entirely without your supervision, so you can go upstairs and actually participate in your own existence. As we wrap up, it's incredible to reflect on how the simple path to wealth successfully bridges the seemingly impossible gap between cold, unforgiving mathematics and deep generational human trauma. It takes the grief of watching a parent slowly crushed by debt, the humiliation of losing your own money to arrogance in a crash, and the primal evolutionary terror of market volatility. And it neutralizes all of that chaos with a brutally simple algorithm. Bleed the leeches, save half, buy the whole market, do nothing. It's a masterwork of behavioral psychology masquerading as an investing manual. It acknowledges the most difficult truth in finance. The greatest threat to your financial survival isn't a market crash, an inflation spike, or a bad broker. The greatest threat is the primate looking back at you in the mirror. It builds a system specifically designed to protect you from yourself. So we return to the very beginning. Financial fear acts like secondhand smoke, quietly suffocating a household. Collins successfully built an air filter for his daughter, and by publishing it, he built one for millions of readers. He cleared the air. But here's one final provocative thought to sit with, one that pushes beyond the borders of Collins' advice. If the ultimate, truest goal of wealth is freedom, and this specific simple path buys you that freedom precisely because it requires zero daily attention, then what happens next? What are you actually going to do with all that reclaimed mental energy? If you successfully escape the rat race, but you spend the rest of your life endlessly optimizing your spreadsheet, tracking every stray penny, arguing fiercely online about international equity allocations, and obsessing over the decimal points of your withdrawal rate, haven't you just built yourself a slightly more comfortable, self-imposed prison? True wealth isn't just learning how to ignore the financial industry. True wealth is eventually finding the courage to ignore your own portfolio.